The information built into candlestick charts allows an investor to analyze things with a lot more common sense in their put into their analysis. We know the T line is a very powerful trend indicator. Thursday, when the markets were trading very positive, the fact that each one of them closed just below the T line was an indication that we didn't have a major reversal as of yet. Even though it was trading positive on Friday, we still needed confirmation, which was a close above the T line after a candlestick buy signal. That close just below the T line should have been a little bit of a caution, not necessarily a big warning, but just saying we shouldn't be ready to buy heavily until we see the market has actually confirmed its reversal. Today, with the pre-market futures showing the market was going to open much lower, was another indication that the T line was still acting as resistance. We weren't in an uptrend. Now, we're now at the point that the Dow actually touched and went through the 200-day moving average, an obvious support level everybody was watching, and did it right here in this level where the market's bottomed out before. So which way is the market going to go? At this point, we don't know, but as a candlestick investor, knowing what the different patterns and confirmations are, we know that if it supports in here and eventually closes up above the T line, this was a base area in here. If they open it lower and close below the 200-day moving average, we now know we have a bearish J-hook pattern, which implies that if this is wave 1, wave 3 is going to take us all the way down here. So what do you do in these type of markets? Candlestick analysis is just merely the graphic depiction of what's going on in investor sentiment. It wasn't a surprise that the market was selling off, or nobody was caught by surprise because the sell signals had already come in. Major trading entities like Amazon. If you went short when it was the appropriate time to go short with sell signals and closes below the T line, on a day like today, you don't have to ask what to do. All you have to do is stay short until a very simple reversal, a candlestick buy signal, and then eventually a close back up above the T line. Trades like Overstock that failed with an evening star type signal right here at the T line, bounced up off the 200 but failed to get above the T line, gapped down through the 200, just tells us one simple thing. We don't have to do anything if we're short. We just continue to stay short until we see a buy signal and a close above the T line. The benefit of candlestick analysis is that as long as there isn't any change of investor sentiment, and one of the strongest indicators is the T line, if they can't get it back up above the T line, you can comfortably stay short until you see that reversal. This allows candlestick investors to sleep very comfortably at night, knowing that they're in the right direction at the right time. That'll be it. We'll see you in the chat rooms.